morning and happy Monday to you. You're watching All You Need to Know on Bloomberg Quint Live, and I'm Alex Matthew. First, the headlines this morning. Asian markets are off to a weak start after trade tensions between the US and China escalated, with China demanding the removal of all extra tariffs. US President Donald Trump, meanwhile, has warned China of harsher terms if a deal is not signed in the near future. Etihad has submitted a binding bid for the grounded Jet Airways. In addition to Etihad, the airline has also received 3 unsolicited bids, one from its employees. ITC and HDFC are the 2 nifty companies to report earnings today. And the penultimate phase of India's Lok Sabha election saw a 64% turnout, according to data from the Election Commission. Let's talk about the US markets now. Stocks closed higher for the first time in 5 days on renewed optimism that an all-out trade war could be averted, even after the US decided to slap fresh tariffs on Chinese goods overnight. Ed Ludlow of Bloomberg News tells you what happened in that session.
US equities staged a late rally in the final hour of trading on Friday as sentiment in the market changed about the ongoing trade discussions between the US and China. It comes against a backdrop of uncertainty, of course. Overnight, the US did raise the level of tariffs on $200 billion worth of Chinese goods. But the sentiment seems to be that an all-out trade war between the US and China can be averted, and that positivity really translated into the final hour of trading on Friday. In terms of where we closed, the S&P 500, the main gauge of US equities, closed up by around 0.4%, snapping 4 days of losses, real strength in utilities and materials. And in fact, of all of the industry groups in the S&P 500, only 1 out of the 11 closed in negative territory. That was healthcare. But it's worth remembering, of course, that the S&P 500 registered a weekly decline of 2.2%, its worst week since December. Elsewhere, the Dow Jones closed up as well, 0.4%, and the Nasdaq, the Nasdaq staged a very late rally to close just in positive territory, up just shy of 0.1%. That risk-off sentiment that we've seen in the markets all week really eased across asset classes towards the end of Friday trading. You look at the Treasury market, the yield on the US 10-year started to climb back up, currently at around 2.45%. And in the currency space, the dollar had been making sort of muted gains all week, but it was actually weaker on Friday against most of its major peers. And if you look at the Bloomberg Dollar Spot Index, that saw marginal declines down by around 0.1%, but little change really, whereas it has been making gains all week. I just want to mention Bitcoin as well, because Bitcoin has registered a 10th straight day of gains. It's its longest winning streak since 2017. You remember in 2017 when Bitcoin hit $20,000. It's currently at around $6,350. That's your markets wrap for Friday. Ed Ludlow, Bloomberg News, San Francisco.
All right, but that's as of Friday. The index futures for the US indices are indicating a bit of a downtick, as much as 1% for the Dow as of now. But that could change over the course of today. Let's look at how the Asian markets are doing this morning. Let's go straight across to Sophie Kamruddin, who's joining us from Hong Kong. Morning, Sophie. How are we looking this morning?
Well, Asian stocks are falling this Monday with U.S. equity futures, while the yen and treasuries are climbing after the U.S. and China ended trade talks without an agreement. Now, Hong Kong markets are closed today, but over in Shanghai, stocks are losing more than 1% at the open, and the yuan is sliding, with the offshore rate breaching 687 a dollar, and further weakness is anticipated. Goldman, the latest to revise its yuan forecast lower, cutting its 3-month target to 695. Now, the Korean won is also under pressure this morning as the Korean finance minister cautions of wider market volatility amid these trade tensions, and the Kospi has slipped below 2,100 points. Semiconductor players are mixed in Seoul. This morning's data showing Korean chip exports fell nearly 32% year on year in the first 10 days of the month. And over in Tokyo, the Nikkei 225 is headed for the longest losing streak since September, with SoftBank extending Friday's tumble after Uber's dismal trading debut. you. And I recall SoftBank is the largest shareholder in the ride-hailing company. Now, over in Sydney, stocks are halting a two-day decline, with financials, though, weighing the most. We have CBA sliding after reporting softer third-quarter profit on more compensation charges. So the ASX 200 off about 0.4% this morning. So, excuse me, I meant to say that it snapped a two-day advance. Back to you.
Thanks so much for that, Sophie. Well, trade negotiations between the US and China ended without a resolution last week, sparking a war of words between the two sides. While China wants the removal of all additional tariffs, US President Donald Trump has warned China of even harsher terms if China does not secure the deal before his re-election or before the elections take place in 2020. Derek Wallbank of Bloomberg News brings you this update.
I think that a lot of people had expected to walk into the market week with a really clear idea of what China was going to do, how they were going to react, what the scale of that reaction was going to be. Instead, there's been moderation, and indeed calls for moderation in the state media. So we're still waiting to see from the Chinese. They've promised that they're going to retaliate somehow with tariffs, but they haven't spelled out exactly what they're going to do. Now, there's a trade imbalance here between the U.S. and China, so it's not exactly an even playing field. Given what the U.S. can conceptually do and what it's threatened to do versus what China can do and what it's threatened to do. But we're waiting, and I think this is longer than a lot of China watchers had thought. Maybe we'll get something today. Who knows?
Derek, it's always a fun question to ask yourself, isn't it? But beyond that, some of the analysis is interesting too. The president seems to be viewing the talks through the prism of the 2020 election, doesn't he?
I think that's right, and the president came out today and tweeted that China probably wants Democrats to win because he thinks that they think that they'll get a better deal out of it. Now, this is an interesting framing, right? Because I think a lot of people had expected that the president was looking at the trade deal, at least in part through the 2020 election. He's made that crystal clear now. But what people had assessed previously is that the president wanted a robust equity market and good news for stocks. Remember, this is the president who says, how are your 401ks doing, the U.S. stock-based retirement vehicle? How are your 401ks doing? Look at the market, things like that. But instead, now the president is actually saying, I'm going to be tougher on China than some Democrats would be. It's a shift. It still means that the 2020 election is the undertone, but it's a shift to say that maybe the toughness is better there, instead of saying, let's go full-on bet for the equity markets. It's a tonal shift. It still means 2020 is underlining, but this is something that I think people should watch really, really closely. This, I think, is going to be an idea that people will probe more over the coming days. But I think that if you're watching for markets, you should watch on this very, very closely. How is the president framing the choice and framing what matters in the 2020 election?
All right, Bloomberg, of course, reporting that those stocks continue today. Let's get you updates from the oil market, where prices fell for the third straight week. Rising trade tensions and increased supply from the US is leading to traders questioning the prospects of the rally sustaining. James Thornhill of Bloomberg News brings you more in this update.
The speculation over the weekend was that the Chinese had invited the top US trade representative back to Beijing for more talks. So they'll be focused on when those talks are exactly going to happen and why we're going to make a breakthrough. At the moment, it's pretty tense out there. Obviously, there's a lot of war of words going on, and it's not great for global risk assets generally. And oil's been caught up with that. So, hard to see a really strong rally until we get more clarity on that issue. On the flip side of the coin, the supply constraints are offering some support on the downside of those markets. And with that in mind, we have a big meeting coming up in Saudi Arabia towards the end of the week for the OPEC joint ministerial meeting, and they will discuss whether they're going to extend those production cuts that had such a big impact on the price at the end of this year so far, whether they'll extend those in the second half of this year. One thing, of course, they'll be talking about trade, but also another thing is the increasing production out of the US. That's going to be a factor for them, because if they're cutting the production and the US is moving into that market, then they won't want to see that happen too much. And with prices still, relatively robust, there's an argument that could be made for scaling back those production cuts. So that's going to be an interesting meeting later in the week.
All right, now Agam Vakil is here to tell you all about the day's trade and also what's happening in the futures and options space. Good morning, Agam. Well, FIs continue to sell. The cues from overseas not the best. Two big earnings today, though.
Yeah, and well, 8 straight days of losses, Alex.
Yeah.
So we're going to wait for there could be some respite, but for now it doesn't seem likely, considering well, a decline of 40 points on the SGX Nifty futures, indicating a soft opening. And well, we are keeping an eye on the Nifty 50, which has declined by around 0.2%. Mid-cap and small-cap indices advancing, so outperforming the benchmarks. And pardon me, similarly, we saw in the Nifty PSU Bank Index also advance. But let's move on and talk about your well, ADRs, and we have nearly 1% advances for Tata Motors, HDFC, and Vedanta. And among others, we don't really have too much movement otherwise. But let's move on and talk about your FIIs. And, you know, selling has intensified, certainly. About another 1,245 crores gone out. On the other hand, DI is buying about 1,000 odd crores. And in terms of your contribution, we're looking at the likes of TCS, HCL Tech, and Tata Steel bearing down on the indices. On the other hand, State Bank of India and HDFC keeping the indices well propped up to a certain extent. But as far as your futures and options are concerned, well, more unwinding coming through. So longs made earlier are now unwinding, considering a 5.5% decline in the Nifty, and the Nifty Bank futures also seeing a 9% decline there. And in terms of well, your open interest distribution, keeping an eye on the 11,400 and 500 mark. In terms of changes in open interest, it is most likely that that's where we've seen most amount of activity. As far as your VIX is concerned, it's up 3.5%, further at around 26.3 in Nifty put call ratio, now edging higher surprisingly to around 1.3 despite the fall. And as far as your well, stocks concerned, Jet Airways remains in the F&O ban, and we do have the likes of IGL, Mahanagar Gas, well, seeing a lot of shorts coming through. Also, V-Guard, to a certain extent, will be in focus in terms of unwinding, keeping an eye on Z Entertainment, Voltas, and Apollo Tyres, but expect some weakness in the opening, Alex.
Thanks so much for that, Agam. Well, have a look at what's making headlines across the globe. Sue Keenan of Bloomberg News brings you the first word headlines.
We start with the White House, which is considering conservative economist Judy Shelton for one of the 2 vacancies on the Fed Board of Governors that President Trump has struggled to fill. Now, Shelton has served as an informal advisor to the president and holds a PhD in business administration. Trump has named 4 people for the 2 open seats on the board, but none of them so far has made it through the selection process. To the latest on Brexit now, UK Prime Minister Theresa May resumes Brexit talks with the Labour Party this week. This amid increasing in-party pressure to abandon the strategy and resign. Senior members from both sides expressed concern that further talks might come to nothing. May is also reeling from the latest opinion polls that show Brexit Party leader Nigel Farage on course to win the most seats at next week's EU elections.
We voted to leave. We didn't vote for a deal. We voted to leave once in the referendum. The year after that, both the Labour and Conservative parties promised us in their manifestos they would honour the result of the referendum. And here we are, nearly 3 years on from that referendum. Brexit's not been delivered. And frankly, given this government and given this parliament, there is no prospect of these parties delivering a clean break Brexit.
To Australia now. Prime Minister Scott Morrison has launched his Liberal National Coalition's election campaign, appealing to what's being called the have-a-go nature of Australian voters. He says his aim is to offer a chance to those who want to realize their dreams. Now, opinion polls are suggesting the opposition Labour Party is heading for victory, with leader Bill Shorten pledging to address climate change and Australia's greenhouse gas emissions. And finally, South Africa's President Cyril Ramaphosa is vowing to clean up his party of what he calls deviant tendencies after his ruling ANC party clung on to power in the latest elections. Now, despite a fairly convincing win, it was the worst ever election showing for the party, with its majority falling below 60% for the first time. The ANC has ruled South Africa since the end of the apartheid system some 25 years ago. Global news 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Sue Keenan. This is Bloomberg.
All right, well, let's turn to the big corporate news now. Etihad Airways became the sole bidder to make a binding offer for Jet Airways. Remember, it already holds 24% stake in Jet Airways. It submitted a bid in the 11th hour, just before the deadline ended on Friday. 3 other unsolicited bids were also received by the lenders. Vishwanath Nair, who's been tracking this very closely, is joining us on the phone line for more. Morning, Vishy. Just trying to figure out what were those other bids like and what happens from here on out.
So Etihad submitted its bid on Friday late evening, just before the deadline passed, and we're not entirely sure what the bid contains. There have been some news reports later stating that it is a non-binding bid. Of course, Bloomberg has not been able to confirm that. But as far as the unsolicited bids go, these were essentially bidders who did not submit an expression of interest or had pulled out of the process earlier last month in April. These 3 include Jason Unsworth, who's a UK-based entrepreneur. There's Adi Group, which is a UK-based investment firm. And there's also the Jet Employees Association that has put together a bid for the beleaguered airline. Now, as we know, on the 17th of April, Jet Airways was grounded and it has not had flight operations ever since. And Etihad, being one of the partners of Jet Airways, is willing to extend some funds to try and turn around the airline. What the quantum of those funds are and what is the condition behind those funds, that is not something we know as of now. But yes, Jet Airways, amongst the 4 shortlisted bidders, only Jet Airways actually submitted the bid. The other 3, which were TPG Capital, Indigo Partners, as well as NIIF, did not actually participate in the bidding process. So everything currently sort of hinges on what Etihad has sought from the bankers and whether the bankers are open to accepting those terms. Because only after that will they be able to actually bring in that money and turn around the airline. So the question is what banks are going to do in the next couple of weeks, how they're able to negotiate a better deal for themselves and for Jet Airways.
Okay, L&T came out with numbers on Friday after market hours. If you're looking at the numbers, top line growth of 10%, so coming in pretty much in line with what we were anticipating. As far as the profit is concerned, profit also in line with what we were anticipating. It was a growth of 8%, but the operational performance was weak. 5,600 crores of EBITDA versus an estimate of 6,000 crore, which means an EBITDA margin miss of over 100 basis points. So that was the big disappointing part on L&T. If you looking at how the numbers were in line with what we were anticipating, but operationally they were slightly weak. So don't expect the most positive start from L&T this time around. Has the guidance been met? Yes, for FY19 they had given a guidance of 12 to 15% on the top line and 10 to 12% order inflow guidance. Yes, both of them have been met. And if you're looking at the internals about L&T this time around, on the balance sheet, no doubt there has been some bit of improvement. Working capital improved almost 200 basis points. ROE improvement, growth in operating cash flows. As far as the P&L is concerned, higher other income and lower taxes aided the profit for the company. Margins for the infra segment fell for the 4th quarter. So that's the big disappointment that came in. And infra segment was impacted by the transport infra projects provision. So overall, on the operational front, the biggest contributor was the infra business, and that didn't do well for L&T this time around. The guidance that they've given, same guidance maintained, 12 to 15% revenue, 10 to 12% operating order inflow guidance. They believe that the order will be back-ended this time around, and margins pretty much similar at the same level, 10.5%. What our brokerage is saying, Edelweiss has raised the target price by 25 rupees to 1875, but the other brokerages, what they indicate is a bit of caution. Investec says that the guidance exudes confidence but is a tall task. JP Morgan says that the infra segment margin is disappointing yet again. Motilal Oswal says that the guidance is reflecting caution, and Phillip Capital says that the weak margins spoil an otherwise decent show. So overall, I think while the numbers were in line, the guidance is a bit of a problem, and the underperformance of the main, that is the infra segment, remains a concern for L&T this time.
In terms of guidance, I think we will have maybe order intake of very similar quantum as we had this year guided. We had guided when we got into FY19 somewhere between 10 and 12%. And I think the quantum would be similar with one distinction. Last year, if you recall, we spoke about front-ending of these orders because the fourth quarter was, we were expecting that the election resulted delays could be there. This time it's going to be the boot is on the other foot. You're going to have possibly the first half very modest because a new government will have to be elected, it had to settle down and portfolios allocated, all of that. So we expect this to go back to leaning towards second half in terms of even growth. So please, when you come back here on Q1, don't badger us for not growing by 16 or 18%. But having said that, I think year as a whole, we do look at next year with optimism. We do think some of the programs that we've launched onto are continuing programs, and they are quite agnostic to change in government. So if the policies were to continue, I think we'll continue to report between 10 and 12% order intake. In terms of revenue, I think we will be somewhere between 12 and 15%. Once again, we're giving a range because depending on the ministry and the consequent changes in the bureaucracy, etc., we need to figure out what are the enablers that makes the revenue progress in terms of project progress, etc. So 12 to 15% is the revenue guidance we have. Margins, I think we've reported about what you saw as segmental margin, but at margin aggregate of all segments, excluding services business, we're reporting 10.5% margin. It's the same as the previous year. So we've held our margins steady. We expected to improve on these margins during FY19. That did not happen. But we hope next year our margins profile will continue to be steady around the same 10.5% level. For a company of our size, close to $20 billion in terms of size, I think to expect 20%, 30% kind of revenue growth is not going to be feasible, number one. Number two, if you look at the mix of orders that we have got, we have become more and more proficient in taking complicated, complex, long gestation orders. These are not quick fix turnaround in 12 months, 14 months kind of orders. Given the nature of the order book, I think the leaning is towards large value orders, complicated orders, and long duration orders. So if you are able to maintain a 15% growth in revenue, given this order mix, I think the company should be deemed to be doing very well.
We consciously moved away from smaller value orders to larger value orders. And as Shankar correctly said, design content has increased and the complications have increased. So this is not that the work is going on. The work is going on, but it is more design and engineering oriented. So it takes 6 to 8 months in many of these jobs to overcome that. Some of this is also process or conceptual oriented. And therefore, it takes deliberations with the consultants or clients to clear the matters regarding engineering and design. And that takes 6 to 8 months in these jobs. And many of these jobs are got in Q3, Q4. So it takes 6 to 9 months for that. And that's what happens during the early part of next year. And then only you start getting relevant procurement and sales out of it by doing the job at site. And thereby what happens is that, in my view, 12 to 15% is healthy. If it is possible to do more, we will. But we have to give some, what you call, a check basis for this process to go on before we accelerate on that. And this is a continuous process every year. So it doesn't mean that next year maybe these jobs will grow faster, but the new jobs that come in will have the same process of going through this, and therefore the cycle continues.
Both in motorcycles and in commercial vehicles, there will be cost impact because of the new emission norms in various ways. So there will be cost impact. We are trying to minimize that as much as possible, but there will be cost impact. And largely, we believe that we will have to pass that on to consumers. So it is a big step that will, or a substantial step, I wouldn't say a huge step, but there will be substantial increases which will happen across the board, but not just for Eicher Motors Limited, I believe for the rest of the industry as well, for Bharat Stage 6. The Kerala region has been a bit weak for us last year, and it's one of our highest index markets and highest market share markets. So yeah, we're working on that, and we think it should come back at some point. In our portfolio, for example, really it's a question of the new motorcycles. So our Interceptor, Continental GT, which are the highest priced motorcycles in our portfolio, there now we've got good demand. We're already absolutely market leaders without any shadow of doubt in the 500cc plus segment in India. So what I'm saying is we've increased the market with the entry of our twins. We've increased the market size by multifold.
Okay, well, we're expecting a steady quarter from ITC with double-digit growth when it comes to revenues, expecting EBIT to move up by as much as nearly 16%, and consequently we could see profits rise as well. We're expecting a substantial expansion in EBITDA margins as well to around 38.7%. In terms of volumes, cigarette volumes are expected to come in at around 7%. These are of course estimates, and the company does not report cigarette volumes. We're expecting steady growth of anywhere between 10 to 15% when it comes to FMCG, but we must take into account that the entire industry has seen a little bit of a slowdown. Similarly, we're expecting steady growth in paperboards and hotels. On the other hand, there could be weakness when it comes to its agri-business. And as far as your raw material costs are concerned, we are keeping an eye on the input costs and the impact that they can have on the gross margins. But on the whole, we're expecting a very strong quarter for ITC, especially compared to its peers, and we will be watching out for the all-important volumes number as well as the FMCG excluding cigarettes business revenue growth.
Even HDFC is expected to report its numbers today, and what we are looking forward to in HDFC is a net interest income figure of about 3,029 crore rupees. That will be a degrowth of about 6% on a YY basis, and profit is expected to be down 10%. On the reported basis, it's expected to be around 2572 crore rupees. However, it's important to remember that the company adopted Ind AS during this year, and hence the numbers would be comparable on a YY basis. Also, spreads are expected to remain largely stable, as even though there was marginal inch up in the costs, but due to higher yields, the company is expected to maintain them. Loan growth seen steady at about 16%, even asset quality as well. What will be important to look forward to in their earnings would be the portfolio buyouts that they do from some of the NBFCs or the other housing finance companies which are stressed at the moment. The company has already reported that they had profit on sale of investments worth about 314 crore rupees, and they assigned loans worth about 2400 crore rupees during the quarter versus nil last year. Also, earnings are going to be driven by the dividends that they receive from their subsidiary to the tune of about 537 crore rupees. Also, it will be important to look forward to how their corporate loan book is panning out in terms of loan growth and in terms of asset quality as well, and what the management says about their residual stake in the merged entity Bandhan Bank and Grah Finance, what they plan to do with that and the timelines involved. So that will be important to look forward to.
There are several stocks we will be looking at today, starting with the important earnings. The first one being Vinati Organics, which came in with a very good set of numbers. Their revenues are up 39% at 297 crores, and margins are at 40.5% versus 30.3% last year. Then we have Avenue Supermarts, which also came in with good results. Their revenues are up 32% at 5,033 crores, and EBITDA is up 27% at 376 crores. Oberoi Realty also came in with good numbers. Their revenues are up 66% at 574 crores on the back of other income, which was up 3 times at 23.8 crores versus 7.9 crores last year. They had a deferred tax reversal of 26.7 crores in the base quarter, and their board reappoints Vikas Oberoi as MD till December 2024. Then SRF is making news as the company plans to sell its engineering plastics division to DSM India, which is a wholly owned subsidiary of Royal DSM Netherlands, for 320 crore rupees. The sale is expected to complete within 6 months, and the division contributed around 209 crore rupees, which is 4.5% to the total revenue of the company in FY18. PC Jewelers will demerge its export division to separate company PCJ Gems and Jewelry Limited Export Division. This export division contributed nearly 28.4% to the revenues in FY18. The new company will be listed on the exchanges, and the shareholding structure will be a replica of the current company. The proposed demerger will enhance the value for shareholders. Shankara Building Products started one new retail store in Bangalore, measuring 5,000 square feet. It has further decided to close retail stores in Rajkot, Surat, Baroda, Nizamabad, Anakapalli and Sindhanur, as some of these stores are not a part of the company's immediate geographic focus. These stores contributed only 1.32% of retail sales in Q4 of FY19, and the net store count after this will stand at 129 stores spread over 5,50,917 square feet.
All right, thanks Mishika for that. Well, ITC will of course be in focus for its earnings today, but perhaps today that will be overshadowed. YC Deveshwar, the non-executive chairman of the consumer goods maker, passed away on Saturday. He was 72 years old. He holds the distinction of having been the longest-serving chief executive officer of an Indian company. He was instrumental in expanding ITC's business beyond tobacco and also warding off a takeover threat by British American Tobacco. All right, well, that's definitely a doyen of the industry passing away. There's a lot that we can talk about over the course of the day. You'll find a lot of all the market action right here on Bloomberg Quint Live. But there are also several stories on the website, bloombergquint.com, that you should consider reading. First up, the Finance Ministry is reworking its strategic sale procedure to ensure outright sale of central public sector enterprises within 4 months of issuance of documents to potential investors. And you perhaps heard this a little bit before. Bitcoin surged more than $1,000 this weekend to the highest level since August, as cryptocurrencies extended their rebound from a slump last month amid the New York Attorney General's investigation of a key part of the market. Virtual currencies had slumped late last month after the New York Attorney General alleged that an $850 million cover-up was ongoing by companies behind virtual currency Tether and Bitfinex, which is one of the world's largest crypto exchanges. Well, that's all you need to know going into trade today, but there's a lot more coming up in just a short while, so do stay tuned. This is Bloomberg Quint.